Welcome to Grounded Not Divided, a podcast about leaders who are getting important things done in the real world. I'm Matt Burgess. My guests on this show all have hard-won real-world experiences. Experiences that shed light rather than heat on society's most vital issues. Today's episode is about cryptocurrency. Depending on whom you ask, cryptocurrencies are either energy-sucking, climate-destroying Ponzi schemes that facilitate illegal activity, or they are a key part of the future of global finance. Whatever they are, the Trump administration has made it a priority to promote them, for example by creating a U.S. strategic Bitcoin reserve. As a longtime crypto skeptic myself, I wanted to talk to someone close to the industry who could challenge my view by making the strongest possible case for crypto. Enter my UW colleagues Brad Rettler and Andrew Bailey, co-authors along with Craig Warmke of the best-selling book Resistance Money, A Philosophical Case for Bitcoin. Bradley Rettler is an associate professor of philosophy here at the University of Wyoming. Andrew Bailey is currently a professor of philosophy at Yale NUS College in Singapore, but he will soon be joining our faculty at the University of Wyoming as well. Brad Rettler, Andrew Bailey, welcome to Grounded Not Divided.
Thank you for having us.
Thanks for having us.
So I'm really excited to have you guys on, partly because you're either my colleagues or my soon-to-be colleagues here at University of Wyoming. And you've written this really interesting book called Resistance Money. And when I wanted to do an episode on cryptocurrency because it's been in the news a lot lately, and because I came into this with a pretty skeptical view of cryptocurrency, which we'll get to in a second. And I asked around, who makes the best case for cryptocurrency that is a good entry point for skeptics. And I kept hearing about your book, Resistance Money. And then I discovered that, two of you are here. And I know the brother of the third author, Craig Warmke. And so I thought, great, let's get into it. So first of all, for the totally uninitiated, what is cryptocurrency?
Cryptocurrencies are digital currencies that use cryptography in some way. So they all use sort of different cryptographic things, and some of them use it in different ways. But what I think is in common for all of them is some way of using this digital technology to do some of the things that banks or other internet-based monetary systems would use. So they would use some sort of proprietary software in a centralized way, a database or something like that. And cryptocurrencies have to do this without usually a centralized point. And so they use cryptography to do a lot of the things that a company would normally do.
Okay, so follow-up question for Andrew. Most people think of money, they think of paper or, some bank mediated transaction online. They may be able to spell the word cryptography, they may not. And so the question for the uninitiated, why on earth would you use cryptography to mediate currency? And what are the problems that it was designed to solve?
It might be worth distinguishing or noting the kinds of disintermediation that's made possible here. And we'll focus on the case of Bitcoin, which is the one case where these promises in fact come true, according to our research. So think of the place of trusted parties in traditional digital monies. Parties are entrusted to make the money in the case of commercial and central banks. They're entrusted to hold the money, custodians for us, so they manage the money, and then they mediate transactions. These include institutions like PayPal, credit card companies, commercial banks in partnership with each other, with the Fed, and so on. So there are these networks of trusted parties that do these key features in money. Now, if you're someone who has access to a very good money and you're allowed to use those systems, you may well be served by them. You can send payments via PayPal and nobody will molest you along the way. You have access to master reserves, master accounts in the Federal Reserve. You have access to commercial bank accounts because you have a passport and because there's nothing dubious about your business. But what if you're not? What if you're someone on the margins? What if you're someone whose speech isn't liked by PayPal, whose political opinions are disfavored by the people who run Patreon or some other tertiary payment networks built atop things like Stripe or PayPal? What if you don't have access to a bank account because you don't have a passport, and so on? These are the kinds of people that are served by a system that disintermediates or that eliminates some of those trusted third parties that run traditional digital monies.
So I'm glad you brought up the distinction between Bitcoin and crypto in general, because that's a very important distinction in your book. I believe the subtitle of your book is The Philosophical Case for Bitcoin. It's not the philosophical case for Hawk Tuah Girls Meme Coin or something, right? So how does, maybe back to you, Brad, how does Bitcoin specifically work? How does the transaction, how does it mediate the transaction? And maybe to get at the tension that motivates Bitcoin, on the one hand, intermediaries to be secure for traditional types of currencies have to be powerful, powerful enough, right, to be able to stop anybody from disrupting the transaction, stealing your money, whatever. So how does Bitcoin try to create a system that is both decentralized and secure?
Before I answer that, I will note in response to what you started to say at the beginning, that right now, according to CoinMarketCap, there are 13.24 million cryptos. So it would be impossible to make the case for all of them. And there are some special things that set Bitcoin apart, not just in terms of the protocol. In fact, it's relatively easy to just copy it and run it again and call it something else. So what really makes Bitcoin unique isn't so much what happens at the level of software, but the origin story and kind of what happens at the social layer. So maybe we'll talk about that in a little bit. What happens with Bitcoin is there are people who are users and there are people who are miners, and there are people who run nodes, and each of these have different roles. So the users are the people who own Bitcoin and they want to transact in Bitcoin. And so suppose I want to send you some Bitcoin. I broadcast an address that I control the password to, the private key. I broadcast a digital signature that proves that I have access to the private key. And I broadcast an amount that I want to send and an address that I want to send it to. And all of the nodes, so for example, I have a node here, I have a node at my office, Andrew has a node. All of the nodes are checking all these transactions that are broadcast to the network to make sure that the digital signature matches up with the address, make sure that the address has enough Bitcoin in it to cover the transaction. And so they're serving as validators, and it's quite easy to do this. The miners are also sometimes running these validating nodes, but their purpose is to publish. So they collect all the valid transactions together, and their job is to put them in blocks of transactions, and the blocks get published every 10 minutes, roughly. So every 10 minutes, there's a new block of Bitcoin transactions that are broadcast to the rest of the network, and then all of the nodes that are doing this validating, they update their ledger with this new block. What guarantees that the miner has the right to publish the block is that they found the answer to a computationally intensive math problem. So they're running this hashing algorithm trying to find a suitable answer to this puzzle. And then as soon as they found it, they broadcast the solution to the network along with the block of transactions that they've collected. And as soon as nodes receive that, they update their ledger, they broadcast the new ledger out with this extra block added, and then the miners, as soon as they see that they've lost the previous race, they're on to doing the next one. So this is how the Bitcoin blockchain grows every 10 minutes, one block by one block, and how you know which block you're on.
Can you speak to how the miners are compensated?
Yeah, the miners get a block reward. I think sometimes I can never remember whether the block reward or the block subsidy refers to an amount of new Bitcoin that comes into existence with each block or is distributed with each block. When Bitcoin first started, that was 50 Bitcoins per block. So if you published one of a block in the first 4 years, you got 50 Bitcoin. That's cut in half every 4 years to the point where we're now at 3.125 Bitcoin per block. So still, depending on what day it is, around $300,000 per block worth of Bitcoin. You also get the transaction fees. So people that are broadcasting transactions, there's a competition to be included in these blocks. They can't be arbitrarily large. There's a size limit. And so if you want your transaction to be in there and you want it now, you add a little bit extra of a transaction fee. Most miners organize the blocks based on transaction fee size. So if it's a particularly competitive time, you might need to pay a little bit extra. Right now, at least, the block subsidy, I'll say, the new Bitcoin is far more than the transaction fees. But these block subsidies get cut in half every 4 years. And so at some point in the future, they will be very, very low. And at that point, transaction fees will likely be higher than the block subsidy.
Andrew, you wanted to add something?
Everything Brad said is true, and yet I can nonetheless envision a listener with their eyes glazing over and wondering, what is the point of all this? This incredible complexity and blocks and miners and hashing and block rewards versus subsidies and transaction fees and so on. And the simple answer is that in order to get rid of trust in a monetary system, you have to do some wild things. Bitcoin is the first system that did those wild things at scale that actually worked. So how can you know in a traditional monetary network that the transaction is valid, that it's not fraudulently creating new money when it doesn't have permission to do so, or spending someone else's money? Well, we use trusted parties to do that. We have auditors, we have regulators, we have oversight. Bitcoin replaces all of those layers of trust with complexity, cryptography, and a distributed network.
So let me ask a pointed follow-up. Suppose that I was a scammer and wanted to get more creative than sending you emails, claiming that you had an inheritance in Bitcoin from a Nigerian prince. What makes it hard to scam the system, and how have people tried to?
It's very easy to scam users. It is impossible, at least so far, to scam the system. The only way of publishing a valid block is by finding the answer to the proof of work puzzle. And the only way to do that is, probabilistically at least, to expend a lot of computing power, which takes a lot of electricity. So the chief cost in attacking the network is in electricity. And if you fail, you can't get that back. So this is one of the ways that Bitcoin incentivizes people to be honest with their computing power rather than dishonest. Now, scamming users is, users are people like us. And so the same kinds of scams that work in other arenas work in Bitcoin. And sometimes it's in fact easier because there are no checks by trusted parties. If I try to send a $50,000 bank wire to somewhere, my bank is going to say, "Are you sure you want to do this? Why do you come in? Let's have a conversation. Why? Who told you to do this? Do you know the person you're sending it to?" There's nothing like that in Bitcoin, right? Addresses aren't linked to identities. If I try to send $50,000 worth of Bitcoin, I've never done that, but I assume that it takes the same number of button pushes as sending $4 worth of Bitcoin. And so once you have sent it, there's also no way of recovering it. There's no mechanism built into the Bitcoin network that would allow you to reverse a transaction like that once it's happened. And in fact, there have been several notable hacks of centralized systems using Bitcoin where the people have run off with the Bitcoin. Everyone's known about it. They've known what addresses the stolen Bitcoin resides at. And they're still unable to recover it through the network, at least. You have to actually go and find a physical private key to those addresses in order to recover the Bitcoin.
Good. Okay. So, Andrew, a follow-up question there, because I think what you just described is very relevant to the argument around energy use, which we'll get to in a second. Why, if it wasn't energy expensive to mine Bitcoin, what bad things would happen?
It's costly to mine Bitcoin, which makes it hard to cheat Bitcoin. One way to cheat is to spend the same balance twice over. And because it's costly to produce blocks, it's costly to produce a block that has a transaction and then to produce the same block again that has that same transaction except sends the same Bitcoin to a different destination. So that's one kind of cheat that we don't want to have and that mining prevents. The other positive benefit or positive effect of a positive marginal cost of production is that it ensures Bitcoin's supply schedule is actually followed. And maybe the easiest way to
And
see
sorry,
that,
just back up. What is the supply schedule? Because you guys haven't, that's in your book, but you haven't explained it yet.
the easy version is that there's a supply cap of 21 million coins, and we're slowly approaching it through these halving events, which every 4 years cut in half the number of Bitcoin produced in each block.
And they're produced via the miners, right?
That's right. That's right.
Okay, sorry, continue. So people could duplicate transactions. What else?
The other nice feature of having a positive marginal cost of production, or maybe this is not a positive feature first, let's just observe that it is a feature. It makes Bitcoin, in an important respect, not like other fiat monies. So it's like other fiat monies in this respect. It has no intrinsic value. So consider a dollar bank balance or the dollar bill. What is the use value of it? Can you consume it? No, it has only exchange value. Similarly, Bitcoins have only exchange value. You can't eat them, you can't live in them, you can't consume them. But unlike fiat monies, dollars, for example, Bitcoin is like gold in this respect. On the margin, it has a non-zero cost of production. You can't just print it willy-nilly. So that conspires with the supply schedule and the other incentives set up in the mining structure to give a very predictable curve to how many Bitcoin there will be at any given time. In fact, we can predict, it's algorithmic, it's just a function of block height. That is how many blocks have been produced. And we know exactly how many Bitcoin there will be at any given time. How many dollars will there be tomorrow? Does Jay Powell know? Does Scott Bessent know? No, nobody knows how many dollars there will be tomorrow, much less 10 years from now. But we can say with an extremely high degree of certainty how many Bitcoins there will be at any given time in the future, or more precisely, any given block height. So that sets Bitcoin apart from both gold and fiat currencies. You see that like gold, it has a positive cost of production, and that keeps supply to heal, so to speak. Because it's costly to get gold out of the ground, you know that it can't just be produced willy-nilly. So also with Bitcoins. And yet it also is like fiat money in this other respect. It is has no intrinsic value. And like digital dollars, can move around the world at the speed of light.
So let's get back to the title of your book, Resistance Money. Hopefully our listeners have somewhat of an understanding of how it works, why it's hard to scam. So let's dig in onto the resistance money idea. Why would, say, somebody in Venezuela want to be using Bitcoin? And how safe are they from government appropriating their Bitcoin?
Someone in Venezuela might have a couple different reasons, probably all working together. So Andrew mentioned the distinct roles in the monetary system of maker, manager, and mediator. Those who create the money, those who hold on to the money for you, those who mediate transactions. And you might distrust all three of those people, or all three of the entities that play those roles in your country's monetary system. So makers, you might think, are going to either make too much money or not make enough money, or make just the right amount of money but give it to people that you don't think they should give it to. So the way that the money is introduced into the system, you might disagree with. And so you might opt for a money where you know exactly how much there will be, as Andrew mentioned, and exactly how people go about getting it. The rules are publicly known, and everyone plays by the same rules. There's nobody who can manipulate that. So Venezuela is a country with reasonably high inflation, at least right now. And so you might think my money is going, my Venezuelan money is going to be worth less in a week than it is right now. And I want to guard against that by moving some portion of it into an asset that I know is not going to devalue, at least due to increased supply. Or you might think, I want to get out of this country. And in order to do that, I'm going to be searched at the border. I want a way to leave with my net worth relatively intact. In order to access your Bitcoin, you just have to memorize some letters and numbers together, or write them down and mail them to some other address, or in some way secure a very tiny amount of data that will allow you to then access your Bitcoin somewhere else. You might distrust or not be able to depend on the people who are mediating transactions. They might want too much or not enough, or they might not allow you to transact. You might be cut off from your financial system, and there's no way to do that with Bitcoin. So depending on who you are and what your role is and what you want, kind of surprisingly, Bitcoin solves all of these different problems at once. It's not just a problem with the creation of money, like for us, the Federal Reserve, but there are also problems with these payment processors. There's problems with banks who you trust to hold on to your money. There have been lots of recent incidents where banks don't give people back the money that they've deposited. This has happened in India, it's happened in Greece, it's happened in Iceland, and a lot of other
happened
places.
Here during the Great Depression, right?
Yeah. So you might think, I don't want anyone else to manage my money for me. I want to manage it myself, and that would be a reason to use Bitcoin as well.
Great. So, Andrew, I want to ask you to state as concisely as you can your core argument. And your core argument, I think, is really interesting. It's maybe something you see a lot in philosophy, but it's not the sort of argument that you see, on X or in popular publications every day. And readers who think that you're going to make the case for the strategic Bitcoin reserve of the United States, which we're going to talk about in a second, my recollection is they'll be disappointed. You don't say everybody should use crypto. All you say, correct me if I'm wrong, is that a world with Bitcoin is better than a world without Bitcoin, based on the idea of, suppose you didn't know who you were going to be in the world, which world would you choose? Can you unpack that and correct that if necessary? Go ahead, Andrew.
Well, you asked for the concise version, Matt, and then you gave it. So thank you for reading and then reproducing the core of the argument. You expressed it as a question. If I didn't know who I'd be, here's how we put it. If I didn't know who I'd be, would I want there to be Bitcoin in the world? So let's think about the example that Brad was discussing, Venezuelan bolivars. I pulled up the chart. In fact, I found two charts. There's the old Venezuelan bolivar, which went minus 100% against the US dollar over the last 10 years. Okay, then I pulled up the newer chart. The 1 week, minus 2%, the 1 month, minus 7.5%, the 1 year, minus 46%, and then 5 year, the 2 years, minus 64%. Okay, so that's a very, very bad situation you're in when the purchasing value of your currency is wildly unpredictable or predictable in the bad direction. How many people suffer in that way? Something like a quarter of the world's population suffers under very bad central bank policy. So if you didn't know who you'd be, would you want there to be an alternative available to you that didn't have that defect, that couldn't be badly run by a central banker because it didn't have central bankers? Well, Bitcoin is such an alternative. Similarly, something like half the world's population suffer under authoritarian rule. Their local rulers will use monetary systems to control what can be said, what can be thought, what can be done. And of course, blocking payments and blocking access to banks is the first step in that kind of authoritarian program. So if you didn't know who you'd be, you have a 1 in 2 chance of suffering under very, very bad and authoritarian local rule that's enforced by both corporate and state agents. Would you want there to be an alternative to you where you could hold the money yourself, transact it without their knowledge or permission? We think the answer to questions like that is yes. So we think that when you take a disinterested view of the world, not asking is Bitcoin good for me, but is Bitcoin good for the world? The answer is yes.
Okay, so now I'm going to put on the skeptic hat and ask pointed questions, some of which are, thoughts that I've had before. Some of those thoughts have softened somewhat. Some of which are arguments that I've heard that, I may or may not agree with, but I'll keep that a mystery just for fun. All right. So keeping with the back and forth theme, Brad, starting with you. You've talked a lot about how the supply is predictable and stable, and that's sort of a stability feature. And you've both talked about how there's this hypothetical person who's disadvantaged and persecuted who benefits from Bitcoin. Somebody might respond to that. Well, first of all, the stable supply has not stopped Bitcoin from being extremely volatile, right? Number one, much more volatile than many currencies, although not as much as Venezuela's, right? And second of all, who actually holds Bitcoin? Is it really these hypothetical downtrodden people you're describing, or is it tech bros in Silicon Valley speculating? What would be your response?
To answer the second question first, because it's easier, yes, it's both of them. And the tech bros each individually hold more probably than the people in Venezuela. And ironically, the people who are most adamant against Bitcoin give these kinds of arguments as though they're discouraging the people in Venezuela from acquiring Bitcoin, and then they say, well, not enough people in Venezuela have it, more tech bros have it. So if you're worried about the distribution of Bitcoin, then I would say to such a person, stop trying to prevent people from acquiring it. Give arguments for it. Tell them that they should. Let those people get into Bitcoin before the tech bros, or at least alongside, rather than having to wait. The first question on the volatility of Bitcoin, there's a couple of things to say. One thing to say is that if you know your currency is going to devalue by 10% against the US dollar this year, you might prefer volatility to this guarantee of devaluation. So it might seem better to you to risk a 50% drop or a 50% raise versus a near guaranteed 10% drop. So there's a lot of people who are living in a lot of monetary regimes for whom the volatility is preferable. The second thing to say is it's really impossible to have both the supply guarantee and no volatility. Just the way that the quantity theory of money works out, you can't have both. So the way that central banks try to meet their mandates of stable prices or low inflation is by manipulating supply, and that's just not available on Bitcoin. There are cryptocurrencies that try to do this. They have oracles, which are things that look outside of the cryptocurrency itself at prices and then try to adjust supply on the basis of that. That introduces another area of attack. if the blockchain has to look outside itself to get inputs about what it should do, then that's a way to that's a thing that you could try to manipulate in order to manipulate the cryptocurrency. And so the inventor of Bitcoin decided to have a fully self-contained system. It looks only at what's happened on the blockchain itself. How fast have blocks come in order to adjust algorithmically? Any other way of doing that cedes control to individuals and centralizes.
Just a quick follow-up. The predictable supply contributes to the volatility because the demand is not predictable, right?
Exactly.
The demand fluctuates. And then the highly limited supply, combined with the fact that it's predictable and, fixed over really short time, or roughly fixed over really short time scales, means that the produces both a positive trend in its value and the large fluctuations in its value. Is that right?
Yeah, I mean, I don't think that we've seen. I've never talked about this with anyone, so Andrew might have a different take. I don't think we've seen effects of the 21 million supply cap on the price because we haven't reached that cap yet. We've seen impacts of the halving of the block reward and of just the predictable issuance so far, but there's still new Bitcoin being created every 10 minutes and coming out. So I think what the overall supply cap has done is made people like Bitcoin because they like the idea of a supply capped currency that can't be raised. They know exactly how much there's going to be at any point in time.
To put a slightly finer point on it, just to put a slightly finer point on it, right? If you've got supply that is increasing at an exponentially decaying rate, and you've got demand that's increasing at a potentially increasing rate, or constant exponential rate, or whatever it is, that's going to result in the long-term increasing trend in the value, right?
Matt, you're an economist, and some of your listeners will be too. The supply curve for Bitcoin is more or less a straight vertical line. You know what follows.
Right. Well put. All right. So volatility is one of the big arguments against crypto. And I think you guys have made it indirectly, but it's worth stating explicitly that you argue, I think, pretty convincingly in your book that volatility may be a good argument against, using crypto as a national currency or something if you've got a stable currency like we do in the US, but it's not an argument against Bitcoin existing or not, right? Back to your core philosophical point. All right, I want to go back to energy consumption. So for Bitcoin, and I think you pointed out in the book that for some other cryptocurrencies, this is less the case, but that trades off with things like security. But for Bitcoin, mining it is very energetically expensive. And correct me if this is wrong, having some type of significant electricity cost is also really important. And so I think that implies that you need energy to be scarce for crypto to work the way it's supposed to, or for Bitcoin, to work the way it's supposed to. And it needs to be expensive. And some people might look at that and say, well, that's going to drive up the price of electricity, right? And if it doesn't work because energy is not scarce. And or that's going to cause big problems for climate change, because many of, if not most of the grids that people are running this on are mostly based on fossil fuels. What's your response?
We take this objection very seriously. And formally, one difference between this objection and some others is that this concerns possibly externalities. So the question isn't, is Bitcoin better on some margin for a user of Bitcoin? The answer there might just be, let them decide. We want a world where they have options. Let them select Bitcoin. If its volatility is worth the price, let them do so. But when it comes to energy use and possible externalities thereof, everybody has a stake, because the positive and external effects that spill over the whole world, for example, carbon emissions, affect everyone. So we spend not one, but two chapters, something like 18% of the book is talking about these things. But we can't reproduce here everything that we've said across those 30,000 words or so. Maybe an initial thought is this. Take a look at whether the energy use on the part of miners is rival or not. This gives us an interesting dilemma, and then we can work out the two sides of that dilemma. So some energy use is rival. That is, you're bidding against some other buyer of the energy. This would be on-grid energy in a city, right as the sun is going down. Lots of buyers of energy, they're turning on their lights and so on. Now, and then take the other horn of the dilemma. This is non-rival energy use, where you're building a dam out in the middle of nowhere and then putting a Bitcoin mine on top of it. What's interesting is that on our view, there isn't really a good objection on either side of the dilemma. So on the non-rival side, let's think about that first. Bitcoin miners going out to the middle of nowhere or bidding for energy that otherwise wouldn't be used. And what's interesting about this is that, yes, it's energy intensive, but those kinds of energy sources on the temporal and spatial margins of our grids tend to, in fact, be the least carbon intensive. So this is an interesting thing about the economics of Bitcoin mining. It's a global contest for a fixed reward, which means margins are razor thin. So you have to find the cheapest mining rigs and the cheapest energy. That actually tends to be the non-rival energy pushing out to the corners of our grids, both in space and time, energy that otherwise wouldn't be used. And that is not carbon intensive. So there's an interesting thought there. Let's turn to the other dilemma, and then Matt, I know you're going to have questions here. Take the rival side of the dilemma. What I note here is that the relevant counterfactual isn't true. And the counterfactual would be this: if we deleted Bitcoin from the grid, would that energy still be used? In fact, it would be, because there's another bidder waiting for it. So removing Bitcoin from the system doesn't actually reduce carbon emissions for that carbon intensive rival use of energy. So we have two options here. One of them is non-carbon intensive, energy intensive, carbon free, carbon neutral, or low carbon, and energy intensive. That's the stuff in the margins. And increasingly, Bitcoin miners are pushed there just by the economics of Bitcoin mining itself. On the other hand, we have rival uses of energy by miners, and removing Bitcoin from the equation wouldn't actually reduce emissions. It would just get the energy we used for some other purpose.
Okay, so let me ask a couple of follow-ups about that. So to use a couple of specific examples, the most non-rival form of energy use that people use for Bitcoin mining that I can think of, which I totally agree doesn't contribute to carbon emissions on the margins, is people who set up data centers next to places where they flare extra natural gas that would be burned off as waste, and now they're using it to mine their Bitcoin, right? That's an example of the alternative is you're literally flaring it, right?
You could say something even stronger. Not
Sure.
only is that not carbon intensive, on a certain way of doing carbon accounting, it's carbon negative, because the
Right.
counterfactual is that it would have been vented rather than flared at all. And methane is in fact 60 times worse than CO2 as a greenhouse gas. So turning
in
methane,
the short term, not in the long term, but
that's right.
But sure.
That's right.
Yeah.
That's right. So turning methane into carbon dioxide, as the miners do when they put a turbine on top of what otherwise would have been vented methane, is in fact carbon negative. And this is it's a small but growing portion of the Bitcoin miners' energy budget.
What fraction is it?
This between 2 and 4% right now. And just 2 or 3 years ago, it was less than 1, almost undetectable.
Okay. I do want to push back a little bit on the notion that if the bid didn't go to the Bitcoin miner, somebody else would bid on it and use it. Maybe in the immediate time scale, that's true, but it almost sounds like you're saying that if I increase demand, the quantity at equilibrium doesn't go up, right? And I'm skeptical of that. So help me square the circle here.
Well, whether a supply of energy can go up in some markets will depend on regulation and the availability, the viability of using fossil fuels there or not. So I agree with you in this very abstract theoretical point, of course.
Well, okay, but let me put a finer point in then. Correct me if I'm wrong, but it sounds like either there's a case where supply can go up, in which case demand goes up and quantity supplied goes up, or the supply is fixed, and then you're saying that Bitcoin is raising everyone's electricity prices, right? It's got to be one of those two things, right? Or is there some third option I'm not thinking of?
When miners are bidding, let's say I live in Singapore. Say there's a mining operation here in Singapore. If they're bidding for electricity against me, they are raising my price. they are unwilling increasingly to do so. So what we're seeing, so I laid it out as a dilemma. What we're seeing is increasingly miners moving to the other side of the dilemma, that is moving to the margins of grids. But you're right. Of course, if they're bidding for electricity, they are bidding up the price. They're bidding against me. I don't want that. Nobody wants that. So that's why they're leaving. It's too expensive for them to be profitable to be bidding when there are other bidders.
Okay, let's come back to the energy thing a little bit. What fraction of global energy use, emissions, or both comes from either Bitcoin or crypto in general, whichever you know? I know one of those is in your book, but I can't remember the number.
I'm pulling up the Cambridge Index right now, and unfortunately, it's not loading, so I can't give you real time numbers. Okay, here it is. The Bitcoin network power demand. This is updated every 24 hours. This is the Cambridge Bitcoin Electricity Consumption Index. 20.27 gigawatts, annualized consumption of 177 terawatt hours.
And what fraction, for those of us who aren't electricity experts, what fraction of global electricity consumption is that roughly?
Bitcoin's share of electricity use is 0.7%, and of total energy production, rather, 0.27%.
Okay,
And the
so
difference there is
half a
because
percent.
a lot of energy that's produced isn't used.
Sure, 0.5%, give or take. And that, I think, was roughly what I was going to guess based on my recollection of reading your book. If you added all other crypto to it, Bitcoin, as far as I know, is by far the biggest crypto by scale. If you added all other crypto to it, just if you had to guess, how much are you adding to that?
Virtually nothing, less than 2 basis points.
Okay, wow. So now we're about 0.5%, right? 0.5% of electricity use. Electricity is a fraction of emissions. Given that there's a fixed supply schedule and the issuance of new Bitcoin halves every 4 years, I think you said, or was it 4 months, 4 years? And you have this asymptote. Assuming electricity doesn't become free, right? There has to be some theoretically predictable ballpark for how much bigger Bitcoin's energy demand could get. Is that totally a wild thought? And has anybody tried to quantify that or predict that?
Well, I think that is exactly as hard as predicting Bitcoin's market price in whatever time frame you're looking at, because the market price of Bitcoin sets the actual purchasing power of the Bitcoins given as rewards, right, and whether it's fees or the block subsidy. So if we don't know the price of Bitcoin 100 years from now, we don't know the purchasing power of the rewards. Thus, we don't know the incentive to produce Bitcoin by spending electricity. So I think of this as exactly the problem of predicting Bitcoin's price, which is exactly as hard as predicting human psychology. The supply curve is fixed, and the demand, well, blows around like the wind.
So let me go to Brad. Go ahead.
What we do see, just real quick, in the short term is we can look around these halving events, because there the market price of Bitcoin doesn't move around that much on the scale of a week. And if you look the week before and the week after, this is a thing that miners, industrial scale miners, prepare for, and they're ready to turn off the moment that the block reward halves. A bunch of places that were once profitable to mine in become unprofitable. A bunch of mining hardware that was once profitable to mine with becomes unprofitable to mine with. And so you do see local drops in electricity use around those events. But then what often happens is, Bitcoin becomes more scarce at that point, and people have heard about the halving. They get interested in Bitcoin. They might want to buy Bitcoin. And so often what happens then after is that the price goes up, and then some of that mining becomes profitable again, and so it sort of evens out. But yeah, it very much has to do with the price of Bitcoin.
Okay, 2 more quick follow-up questions about this.
Matt, could I just draw a parallel to gold?
Yeah, sure.
How much will be spent 20 years from now extracting gold from the earth? Well, we need to know the price of gold to really answer that question intelligently. That would be very helpful in modeling it. So also here, because the cost of production will rise to meet the value of what is produced.
Okay, so two quick follow-up questions, and either of you can take them. One that's somewhat unfriendly and one that may be somewhat friendly.
Oh, I want the unfriendly one, please.
Good. The unfriendly one's coming first. So you're maybe 0.5% of electricity use now, right? So definitely less than 0.5% of emissions. But you don't know how much energy might be expended in the future. Say there's a future where everybody reads your book and suddenly you have 3 billion Bitcoin users. Is it inconceivable to imagine a Bitcoin share of emissions that is 1 or 2 orders of magnitude larger as a fraction of global emissions than it is today?
Now, Matt, you've correctly pointed out that Bitcoin's share of emissions is lower than its share of energy use. I'm pulling up the Cambridge data right now.
Sure, because electricity is right as a fraction of emissions.
That's right. That's right. But even Bitcoin's share of that, it is less carbon intensive than any other major industry, precisely because it's pushed to the margins, and it can be done anywhere in the globe, and it's agnostic with respect to place or time. Unlike, say, aluminum smelting, which needs to be near where aluminum is to be found.
Sure, but is it conceivable that the share of emissions could grow by 100 times if 3 billion people started using Bitcoin?
In the short term, yes. Here's what that looks like. If Bitcoin was worth $1 million per coin, it would be profitable to once again mine Bitcoin in Singapore. 20 cents, 30 cents, 40% cents per kilowatt hour, still profitable to mine Bitcoin here. I predict, though, that those kind of short-term events, an explosion in the price, is eventually tamped down by global competition for mining. And this is what we've seen with short-term price spikes, is that people turn on miners that used to be unprofitable. But because the reward is fixed and you're competing against everybody, the people who have the cheapest electricity win out, and you're basically pushed out of the race. And then again, the relentless arrival of halving events every 4 years pushes down margins as well. So in the short term, yes. And this would actually be quite bad for Bitcoin's carbon profile if this price spiked dramatically.
But let me push on that a little bit. So if the fraction of the global population increased dramatically that use Bitcoin, that wouldn't be a temporary price spike given the fixed supply schedule. That'd be a permanent price spike, wouldn't it? And
but
so
I
wouldn't that yeah, go ahead.
I think one of the things Andrew's saying is you might turn on some miners in Singapore, but it's still much more profitable to mine, let's say, in China on a hydro power. So the miners in China are going to want the hardware that's been turned on in Singapore, and they're going to be able to offer more for it than the people in Singapore will be able to get from mining Bitcoin with it. And so the hardware is still going to keep flowing to the places where it's most profitable to mine Bitcoin. And that is the non-rivalrous energy use, especially the low carbon, solar, wind, hydro, geothermal, those sorts of things.
So just to tie this off, because I want to move on, would it be fair to say that we don't know exactly what the effect on emissions in terms of how much it would increase would be of a drastic scaling up in the use of Bitcoin, but we can be pretty sure that it would be positive and sublinear. So it would if more people use Bitcoin, we're going to spend more energy on it, but the amount of energy and emissions that we spend will go up much more slowly than the number of people. Is that accurate?
Over a long enough time frame, yes. There's one more dynamic we haven't mentioned here, which is the so-called difficulty adjustment. Basically, as more people enter the mining game, the harder it is to win the game. And this, which is adjusted every 2 weeks by the protocol algorithmically, nobody has a choice about this, basically smooths that out over time and makes it, after the difficulty adjustment, far less profitable than it was just 2 weeks earlier after that price spike. So this is one of the dynamics.
Energy expensive, right? That's how it makes it less profitable, right?
That's right.
So okay. I think Matt, there's a lot of moving parts here that have to do with the competition for energy use, the alternative. So if 3 billion people start using Bitcoin, what happens to the energy that is used right now in securing, say, the US dollar system? Are these 3 billion people all moving out of the dollar? Do we no longer need to guard the gold at Fort Knox? All these computer systems. So there's a lot of trade-offs and distinctions that are difficult to measure. My suspicion would be that this would be the rise in value of Bitcoin, given its low location demands. This would be one of the best things for carbon neutral or carbon negative energy technologies, because all of a sudden there'd be this massively profitable way of using solar and wind and things like that, and people would turn up investment on those things in order to use them to mine Bitcoin at this high price level.
So, Brad, you've well anticipated the friendly question that I was going to ask, which is, I haven't seen anybody compare the energy demands of Bitcoin to the energy demands of all of the security systems in the traditional financial system and and other infrastructure that it's replacing. So, can either of you comment on that? Has anybody tried to quantify that? Do we have a reason to think that it's significantly more or less than Bitcoin if you're comparing apples to apples?
We really have no idea, because what's used in securing Bitcoin in terms of energy and electricity is very obvious, and it's one thing, and it's easily measured. The things that are used to secure other financial systems are humans, and we use energy. We use energy. Some people defending, say, Fort Knox when they could be doing something else. So there's opportunity costs of these other things. We don't know how much needs to be used, and energy that is in defending and securing these other monetary systems. How much is excess? So we tried to do that for the book, and we didn't even know what the denominator was. Are we using M2 money supply? Are we using M1, M3? Are we using all of the GDP of the U.S.? And so it turned out to be an equation that we just couldn't figure out either side of, and ended up not being able to do. And that's, I think, one of the virtues of Bitcoin, but also one of the things that makes it a target, is because it's very straightforward how to do these calculations with Bitcoin. You can know how much energy is being used, roughly what percentage of it is natural gas, what percentage is coal, what percentage is solar, and do the calculations pretty easily, whereas that's nearly impossible for other monetary systems.
Andrew, it sounded like you wanted to come in. Go ahead.
One challenge we faced when computing this, which we did in a draft version of the book, is that there's many layers to security across traditional monetary systems. From on the government side, local, state, and federal agents, there's a problem of double counting. So a cybersecurity officer and her salary at a bank, how much of that is securing digital dollar bank balances and doing other stuff? Nearly impossible to compute. Now, nonetheless, I'm going to issue an irresponsible guess. This is based on that old napkin math from our chapter draft, which is that there's something like an order of magnitude difference in favor of the dollar to Bitcoin on this respect. That is that Bitcoin is something like 10 times more costly to secure than the dollar. And this is just a trade-off, that Bitcoin can do things that digital dollars can't. And so users pay for that by paying fees and by accepting new Bitcoins that are created, i.e. diluting their supply. So Bitcoiners want a money that can route around authorities, and they have to pay for it. It's cheaper to use digital dollars if you have access to them. Roughly an order of magnitude difference is the guess. But we didn't publish that, and it was not peer reviewed. So take that as the irresponsible guess circa March 2022, when we last tried to do the napkin math.
Good. I love back of the napkin guesses, and appropriately caveated, of course. All right, we're running a little bit low on time, so I want to make sure I get to the last two questions that have to do with contemporary, less about what's in the book and more about stuff that's being debated in public policy contemporarily. And I'm talking about crypto in general, and also Bitcoin. And when you're answering, feel free to distinguish between the two to the extent that it makes sense. So first is that there's been a lot of talk in Western countries about that we need to regulate crypto more. It's too unregulated. Do you agree? And if so, what do you think are the most important regulations that are missing? Or if you disagree, what is the error that is being made logically by those calling for more regulation?
Crypto has been widely used to perpetuate many frauds in recent memory, perhaps FTX most importantly. What we saw in that case was not that we needed more regulation. In fact, my own view is that regulations already in the books should have been enforced. Securities laws, wire fraud laws, uh, general laws against taking money from customers. So, what's the problem there has nothing in particular to do with crypto or Bitcoin in particular. It's just that people like Sam Bankman-Fried found ways to scam regulators, to get meetings with Gary Gensler where no one else from the industry could, to get kisses blown at him from representatives from California. Maxine Waters just went gaga for this guy. So basically got in bed with lawmakers and regulators and was able to perpetuate widespread fraud. The problem there, we don't need new regulations to catch that. We just need regulators that aren't so easily bribed and that aren't so easily charmed by this curly-headed fellow doing weird things when testifying before Congress.
And to your point, he's in jail now, right? Based
That's
on
right. So there's a
existing
happy
laws.
ending to the story in that respect. But billions of customer funds were lost.
Yep. But basically, to put a finer point on your point that the crypto wasn't necessarily material to the fraud, am I wrong in saying that if you strip it down to its bones, he set up a bank, got a bunch of people to deposit money in the bank, and then took their money?
That's right.
He could have done that with a bank,
Yeah.
right?
That's right.
One of the things about crypto that makes this more common is that it's newer, and so there are fewer people in the regulatory agencies, especially the boots on the ground, so to speak, that understand it and that can follow it and that can track it. But he lied and fabricated things in ways that that were almost impossible to catch until they came crumbling down. And it would have been very easy to do this in a non crypto way. He kept two sets of books and gave regulators access to the fake ones. So it's hard to catch that if you're not expecting it. And so, yeah, in a lot of these cases where crypto gets blamed, it's really not crypto that's the problem. Now, maybe what is happening is, in fact, I think this is happening, is that more people are rushing into this with less knowledge, especially young people, because they see it as their chance, maybe this generational opportunity to get in early and make enough money to live comfortable lives. I think, at least in talking to my students, that many of them see a slow savings plan as not workable for their generation. They don't think they're going to be able to buy houses and have families if they put money in savings accounts and in the S&P 500. They think their chance to make it is crypto, and so they're rushing into a lot of these things without knowledge themselves. I don't think the right answer is to bar them from investing in crypto. Some people have suggested that, and I think that's too paternalistic. But we would do well to educate them about the difference between Bitcoin and Dogecoin and these other things, and talk about what the purpose of a lot of these different cryptos is, and which cryptos have a purpose and which ones don't. And I think a lot of our students don't understand investing well enough to do that. It's a lot like penny stocks, and this is their generation's version of that in a lot of ways.
So let me try to put a finer point on what you're getting at, I think, Brad, and then Andrew, please correct me if I've got anything wrong or add anything on that's important that I'm missing. One of the things you mentioned in your book, which just absolutely blew my mind, was the value of a Bitcoin was something like less than 10 cents, right, in the early 2010s. And then now it's hundreds of thousands of dollars, right? Do the math.
Yeah.
Holy cow. You want to be the person that mined 50 Bitcoins or whatever it was, at the beginning. And you can imagine, projecting that onto other newer cryptos. Now, on the others, and so that's the thought that's probably motivating a lot of these students you're describing. Now, the flip side is a big criticism of cryptocurrencies, maybe less Bitcoin than some of these other ones. Certainly, the newer kind of meme coins, is that they can be Ponzi schemes, and sometimes they're even pump and dump Ponzi schemes, right? Where there's an initial issuance. This is what, for example, the Hawk Tuah girl, Haley Welch, was criticized or accused of, I should say, doing. Is you have an initial offering, you give a bunch of it to your friends, then you pump up interest, and then that raises the price, and then all the people who got the initial offering take their money out, and everyone else has lost their money. As far as I understand it, cryptocurrencies, particularly newer ones, have sucked a lot of people into that sort of scheme, but also that sort of scheme is already illegal to the point related to, Sam Bankman-Fried, what he was doing was already illegal too, and he's in jail for it. And, and so people might go to jail for episodes like the hot coin. So I guess my two questions or three questions. First of all, did I get that right? Second of all, if I did, is there any type of activity that would be illegal with regular currency that isn't illegal with crypto, therefore demanding new regulations? And third, are there new regulations that we could put in place that might help prevent people from getting sucked into these types of scams? Or is it just, you just have to wait for enough people to fall into it and enough publicity that other people, know better next time? Andrew, first, what are your thoughts?
Here is a broad observation, which is that Bitcoin, in our hands, as we conceive of it, is designed to route around regulators. So there's something of a tension in talking in doing the policy work that we sometimes do. Brad and I are both senior fellows for the Bitcoin Policy Institute, talking about apt regulation for securities, how to distinguish securities from commodities, anti-touting laws, and so on, from the very nature of Bitcoin, which, because it does away with these mediating authorities, makes it harder to regulate. And in fact, in our view, that makes it good. It makes it more cash-like because you can hold it yourself. You don't need a regulated entity to hold it for you. You can transact without the participation of a regulated entity, and so on. So I just want to bring to the fore maybe that tension, which is subtle here, but it's not subtle at all once you notice it.
It's a core tension in your book, right?
That's
that
right.
Basically the bad things, the things about Bitcoin that people say are bad, exist precisely and necessarily because they get, they're a side effect of the things about it that are good. And so if you wanted to have less of the things about it that are bad, you would necessarily also have fewer of the things that are good, right?
That's right. The opening sentence of the book, I'll spoil it, is Bitcoin is for criminals. On our view, does not make Bitcoin good or bad, because some criminals are good and some criminals are bad. But it is a plain fact that Bitcoin does enable some things that are criminal misconduct or labeled as such. For example, a woman in 2013 having a bank account in her own name, criminal misconduct, bad, illegal. What? No, that's not bad. Illegal, but not bad. So this is one kind of criminal misconduct Bitcoin enables, is women having accounts under their own name.
In some countries that are not the United States.
That's right.
Yeah.
And there are things that are not illegal, but are nonetheless sanctioned by corporate entities. Having politically disfavored speech will get you kicked off of any third-party payments platform, Venmo, Zelle, PayPal, and so on. If you promote things labeled once as conspiracy theories, now perhaps thought to be true, things about where certain viruses came from in Wuhan, you could get kicked off these payment platforms in 2020. Not criminal misconduct. In fact, it's legally protected speech by the First Amendment for Americans. And yet, nonetheless, sort of dubious conduct. That's the kind of thing that Bitcoin enables. Okay, so there's just the tension laid out explicitly that we think of Bitcoin as anti-regulation technology. And now we're talking about, well, are regulations good? Which ones are good? Which ones should be enforced? I'll highlight a specific one that we've sort of gestured at, but which is anti-touting laws. A lot of these micro cryptocurrencies have been promoted by celebrities who have not noted explicitly that they're being paid to do so. And virtually no one has been prosecuted for this, whether in the civil case from SEC or DOJ pursuing criminal charges. But this is misconduct in both of both kinds. And though Kim Kardashian has been fined for this, basically nobody's gone to jail for it. Nobody has really faced serious fines. So my own view is that we could use more anti-touting laws. And if you like markets, you'll like something about this because it ensures information symmetry between parties, that the buyer of the crypto knows that the seller or the person touting it is in fact a seller, that they have been paid by the producer and so on. So full knowledge enables consent and enables much better markets and less predatory activity that takes advantage, for example, of Brad's students who rightly want to chase the pump, or who rightly want to find some way to get ahead in a world where it's kind of tough to do so.
And just quick clarifying question, just to make sure it's clear. Anti-touting laws they don't say you can't tout, they say you can't tout without disclosing
That's
your
right.
conflict of interest,
That's right.
correct?
Exactly so.
Because if you're a famous person talking about what you're doing,
Gwyneth
right?
Paltrow is allowed to tout her goop, but she is allowed to do so because we know that it's her goop, and she has said
Right.
so. If she
Right.
had some covert relation to the producers of goop, then that would be legally dubious. And
Okay,
all that is good, on my view. Anti-touting laws are vital consumer protections, not because they blockade markets or something like that. They actually enable good markets.
Right. Information is good for markets.
That's right.
Okay, last topic really quickly before we run out of time. And that is the Trump administration, which was just inaugurated a few months ago, has taken an interest in boosting crypto. And for example, there's a March executive order that establishes, quote, a strategic Bitcoin reserve in the United States digital asset stockpile. Trump also has, and his family members have a meme coin. We don't need to get into that. But I want to talk about the idea of a strategic Bitcoin reserve or a strategic crypto reserve. What is that, according to its proponents, what does that accomplish? And and how successful do you think it might be at accomplishing what it's supposed to accomplish?
I'll say a bit about what it's supposed to accomplish, I think, and then Andrew can say whether he thinks it'll do a good job. So I think the idea is that the U.S. has for a long time maintained a strategic gold reserve, and it's because of a few reasons. One, gold is valuable. Two, we had a lot of gold. Three, other countries have a lot of gold, and so we, in some ways, can dampen how much value other countries will get from their gold, how much ahead of us they will be in terms of gold, and things like that. It also serves as some sort of backdrop to the US economy, although that has gotten less and less over the years. And so I think the main idea with the strategic Bitcoin reserve is the US already has a lot of Bitcoin. They've seized some of it, or all of it, I guess. They haven't bought any, but they've confiscated Bitcoin and seized Bitcoin and held on to it and sold some of it, but kept some of it. So there's already this amount of Bitcoin that the US owns. Other countries are starting to buy it. As far as we know, they easily could start to buy it. We really don't know what their position is, but it's an increasingly profitable asset that we already have some of. And so, for geopolitical reasons, we don't want other countries to make massive profits, billions or trillions of dollars in profits on Bitcoin that we don't see any of. And so, since the US already has this Bitcoin, they may as well hold on to it and then profit if other countries also profit. And if Bitcoin goes down in value significantly, well, we haven't spent anything on it. We're just putting aside the Bitcoin we already have. Now, there's attempts to go further in that and actually buy a lot of Bitcoin. Our own senator has advocated for that. That seems like a different thing and requires a bit more confidence in Bitcoin than what I've said.
But let me just stop you. So
sure.
There's the argument, we think Bitcoin value might go way up. So anybody with the capacity to buy an asset that's going to go way up should do it. The US government is an entity that can buy a bunch of assets. We should do it. Is it that simple, or is there some other reason akin to the gold standard, strategic reason besides just it's good if the United States government makes money?
I mean, so it's not just good if the United States government makes money. It's because I mean, that would have the United States government buying Apple stock and Tesla stock and other things like that. But some of it is that we expect other countries will be buying it, specifically countries that we have geopolitical tension with, like China and Russia. We expect that they might even conduct trade using Bitcoin rather than using US dollars. And so if that happens, the US could either not benefit at all or could benefit. And so it's better to benefit than to not benefit.
Andrew, go ahead.
Brad drew the parallel to gold held in Fort Knox, and I think there's an insight to be drawn from that. That gold has no strategic importance to the United States in any discernible dimension. We haven't touched it. It's played no monetary role since the summer of 1971. It just sits there. If all Bitcoin is going to do is just sit there on the balance sheet of the Treasury, then I think it will be approximately as useful or good as gold in Fort Knox, which is not at all. So if I were to make a case for strategic Bitcoin reserve, it wouldn't be based only on pumpamentals, the idea that it will go up in value, a pump, because that doesn't uniquely select Bitcoin across other assets, as we've noted. Nor would it be just based on the parallel to gold. There has to be some actual strategic, that is unique use that promotes American power abroad, unique geopolitical use. So my own annoyance is that many proponents of the SBR have failed to actually use the strategic side. They failed to develop any strategy here. Now, I have an idea for that argument, how that argument might go. Suppose the world increasingly fractures and that countries and alliances that are now allied in the future aren't allied, and that payment networks are closed down, that channels that were once open are closed. China, Russia emerging as global superpowers, the United States not necessarily aligned with the European Union, and so on. Now, in that world where payment networks are blockaded and where alliances that have been with us for 70 years have fallen, would it be useful not just to hold, but to actually have something to use, an asset that can be traded globally, that can be spent without the cooperation of these payment networks, that can be spent to from a state to a firm that is not connected to the SWIFT network? Maybe so. So if I were to build an actually strategic case for acquiring Bitcoin, it would be along those lines. Proponents of the SBR typically do not do so. Instead, they talk about how Bitcoin is likely to appreciate in value, and that by acquiring Bitcoin now, earlier than other nation states, there's some sort of early mover advantage, and that the United States can later sell Bitcoin or directly redeem debt, retire debt by paying it off in Bitcoin terms.
Well, guys, this has been totally fascinating. We're out of time. If you found this discussion interesting, I encourage you to pick up their book, Resistance Money, The Philosophical Case for Bitcoin. I think there's something in it for everybody, whether you are a Bitcoin proponent or a Bitcoin skeptic coming in, as I was. Super interesting. Thrilled to have you both as my colleagues, and we'll see you next time.
Thanks for having us.
Thank you so much.
Thank you for listening to this episode of Grounded Not Divided. If you want to hear more episodes like this, be sure to subscribe for free on Apple, Spotify, or on the Guided Civic Revival Substack. You can also email us feedback at matt.burgess@uwyo.edu. See you next time.